Welcome to a deep dive into Luxembourg's debt financing ecosystem, a really crucial area if you want to understand the engine room of the financial sector here.
And absolutely.
Today, our mission, tailored for you, is to unpack the common debt financing options available in Luxembourg, where they get SOPARFIs and the various investment fund structures.
Yeah, the whole zoo. UCITS, SIFs, SICARs, RAIFs, other AIFs.
Exactly. We're essentially providing a focused analysis, right? How these entities actually access and use debt in Luxembourg.
Mm-hmm. And this is based on our information cutoff date of May 9th, 2025, so pretty current.
Right. Our insights today are drawn from the Luxembourg Debt Financing Deep Dive Report, which is current as of that May 9 date, plus key Luxembourg legal texts and the latest regulatory updates.
Updates from both the CSSF, that's Luxembourg's main financial regulator, and also ESMA, the European Securities and Markets Authority.
Our goal is really to clarify the who, what, where, when, why, and how of debt financing here.
Specifically focusing on what the lawyers, finance professionals, directors, compliance officers, committee secretaries listening really need to know.
We'll navigate the legal and regulatory framework, touching on those pivotal laws like the big one from 1915 on commercial companies.
The LSC, yeah. And the 2005 law on financial collateral arrangements, which is super important, plus specific fund product laws and recent EU development.
And we'll be dissecting the debt instruments themselves, from your standard bank loans to all sorts of bonds.
Right. Convertible, subordinated, plus notes, warrants, and those interesting hybrid instruments like PECs that kind of blur the lines.
Okay, let's get into it. So why Luxembourg? Why has it become such a powerhouse for this kind of activity?
Well, it's solidified its position for several really compelling reasons. I mean, first off, it's the second largest fund domicile globally.
Only the U.S. is bigger, right?
Exactly, and it's a absolutely pivotal European hub for both UCITS and AIFs. Just to give you a sense of scale, by the end of 2023, private equity AIFs in the EEA had something like EUR 0.9 trillion in net asset value.
Wow. So that sheer scale, that concentration of capital, it naturally drives demand for, sophisticated financing.
Precisely. And Luxembourg offers this really attractive combination. You've got a stable economy, a regime that actively welcomes foreign investment, and a tax system that can be quite advantageous, backed by a huge network of double tax treaties.
So that attracts holding companies, investment platform.
Both, yeah. And it feels like the success of the fund industry itself created this kind of positive feedback loop, didn't it? Fostering expertise, driving robust legal frameworks.
That's a really crucial insight. As more funds set up here, the demand for innovative financing just shot up. Think about capital call lines, subscription facilities.
NAV-based lending against fund assets, even ways to get permanent leverage. And this demand, in turn, it pulled in a critical mass of specialized service providers, legal, tax, financial.
Right, so it becomes this whole ecosystem. You can manage the entire life cycle of an investment structure, financing included, all right here.
Exactly. It's comprehensive. Now, maybe we should dig into the legal foundations, starting with that cornerstone, the Law of 10, August 1915 on commercial companies.
Yeah, the LSC, the bedrock, really, for corporate law here. It sets the framework for SOPARFIs, SAS, SARS, SEAS. And a key bit for us today is the flexibility it offers for issuing bonds. Right?
Yes, and what's really important to grasp there is Article 114 of the LSC. This basically says any Luxembourg company can issue bonds or obligations.
Any company, okay.
Now, Articles 471 to 470-19 provide a sort of default rule book for bond issues, but, and this is key, the law lets the specific terms of a bond issue deviate from those defaults.
So companies get significant room to tailor their bond terms to fit their needs, market conditions.
Precisely, and it goes even further. For bonds under Luxembourg law, companies, including SAs, can choose to just completely ignore that statutory bond regime in the LSC.
Really? Disapply the whole thing.
Yes. And what's more, Luxembourg companies can issue bonds governed by foreign law, think English law, New York law, which are common internationally. And if they do that, they can opt out of all the LSC provisions on bond issuance.
Okay, that really highlights Luxembourg's, pragmatic, market-driven approach, prioritizing contractual freedom, aligning with international practice.
Exactly. It's about empowering companies to craft financing that meets their commercial goals and, what investors expect. It boosts Luxembourg's competitiveness as a global hub.
Okay, so the LSC provides the structure and bond flexibility. But what about securing the debt? That's where the Financial Collateral Law from 2005 comes in, offering crucial protection for lenders.
Indeed, that law is absolutely critical. It establishes a robust, predictable, and, importantly for lenders, a very creditor-friendly regime for secured lending here.
Creditor-friendly, that's the phrase lenders like to hear. What exactly does it cover?
Well, its scope is pretty broad. It covers a whole range of financial instruments: shares, bonds, debt securities, money market instruments, derivatives, fund units, you name it.
Okay. And also cash claims, like funds sitting in bank accounts. And the law works with various security types, pledges, ownership transfers for security, fiducie sûreté, repos.
And I understand setting up these security interests is meant to be efficient. Less red tape.
Yeah, perfection is streamlined. For registered shares, you just note it in the share register. For a bank account pledge, you notify the bank. The key is it needs to be evidenced in writing to be effective.
But the real strength, especially for lenders, is how it handles enforcement and borrower insolvency, isn't it?
Absolutely. The key advantages are, well, first, what's often called bankruptcy remoteness.
Meaning the collateral is shielded from the borrower's insolvency process.
Yeah, largely, yes. It's protected from insolvency proceedings against the provider, including immunity from those suspect period rules that can sometimes unwind pre-bankruptcy transactions.
That's huge for lenders, massively reduces risk.
Precisely. And enforcement is swift. If an enforcement event happens, the lender can generally enforce out of court without prior notice unless they agreed otherwise. How? Appropriation. Sale.
Either appropriation at an agreed value or a private or public sale. Very practical.
And even with the recent updates to Luxembourg's insolvency laws, these core protections for financial collateral are still solid.
Yes. The Law of 7 August 2023 on business preservation largely kept the safeguards. Enforcement is still possible even during a stay of payments under the new judicial reorganization procedure. And they broaden the definition of winding up proceedings to cover collective agreements, which actually strengthens the protection.
So this law really cuts down lender risk, makes Luxembourg attractive for secured debt, cross-border finance, and especially, I guess, fund finance.
Definitely. Now, we can't talk finance without the regulators, the watchtowers, and rulemakers. Who are the key players nationally?
Right. The CSSF is the main one, isn't it?
Yes, the Commission de Surveillance du Secteur Financier, or CSSF. They supervise the majority of investment funds, banks, investment firms. But it's important, SOPARFIs generally aren't under direct CSSF supervision unless they do something regulated, like a public offering.
And AIFs.
RAIFs aren't directly supervised at the fund level either. It's their managers, the AIFMs, who are overseen by the CSSF.
And the CSSF uses circulars, regulations, FAQs to guide the market. What about the tax side?
Two key authorities there. First, the AED, Administration de l'Enregistrement des Domaines et de la TVA. They handle indirect tax, like VAT registration duties. That can impact transaction costs.
Okay.
Then there's the ACD, Administration des Contributions Directes, the direct tax authority. They look after interest tax treatment, withholding taxes, tax rulings, double tax treaties, and crucially, it's their administrative practice behind that well-known 85.15 debt-to-equity ratio for SOPARFIs using related party debt for participations.
Right, the 85.15 rule. Okay, those are the national players. But Luxembourg is in the EU, so EU rules and bodies must have a big impact too.
Absolutely huge. ESMA, the European Securities and Markets Authority, is vital. It promotes consistent supervision across the EU, develops technical standards, guidelines for key laws like AIFMD and UCITS.
And the CSSF incorporates those ESMA guidelines.
Yes, into its own approach. And then, of course, you have the EU directives and regulations themselves. Find them on EU RLEX, plus the binding interpretations from the Court of Justice of the EU, the CJEU. That's another layer.
So it's definitely multi-layered. National laws, tax rules, CSSF oversight, overarching EU legislation, all interacting. Navigating that must require specialist expertise.
It certainly does. Think about a SOPARFI issuing bonds. It benefits from LSC flexibility, sure, but the tax on interest payments, that's ACD practice, a public offer. That brings in the prospectus regulation enforced by the CSSF. And if that SOPARFI is also an AIF, then AIFMD rules apply via its AIFM. Complex, but ultimately well-defined.
Okay, great overview. We've set the stage Luxembourg as a hub, the legal and regulatory basics. Let's move to part 2 and really unpack the SOPARFI. What makes it such a flexible financing vehicle? What is it beyond just a holding company?
Right. Well, at its heart, a Société de Participation Financière, or SOPARFI, is just an ordinary, fully taxable commercial company under that 1915 law. It's not a special fund regime. That's crucial.
So standard corporate entity.
Exactly. Now, its main job is often holding financial stakes and financing subsidiaries, but its corporate purpose can be broader. It could run other commercial or industrial activities if it gets the right business license.
And unlike most funds, it's generally not directly supervised by the CSSF for just holding shares and lending downstream. That must give it flexibility.
Huge flexibility and speed, both in setting up and managing day-to-day. SOPARFIs can take various legal forms too: SA, SARL, SCA, even a Coupe SA or a European company, SE. Minimum capital depends on the form.
Any limits on what it can invest in?
Nope. Virtually any asset class is fair game shares, bonds, real estate, IP, loans. This adaptability in form, activity, assets, adaptability makes it incredibly versatile, like a Swiss Army knife for financial structuring.
And its ability to issue all sorts of debt adds to that utility.
Absolutely. Plus, because it's a fully taxable company, it gets access to Luxembourg's tax treaties and EU directives like the Parent Subsidiary Directive. That's critical for international tax planning. So yeah, much more than just passive holding.
Now, when it does use debt, are there specific rules, especially on debt-to-equity ratios, interest deduction limits?
Well, Luxembourg tax law doesn't set statutory debt equity ratios, but the tax authority, the ACD, has that administrative practice, the 85.15 ratio.
Right, for financing participations with related party debt.
Exactly. Stick to that generally, and you should get full interest deduction. Breach it, and the excess interest might be seen as a hidden profit distribution, non-deductible.
So 85.15 is a sort of practical safe harbor for related party debt financing acquisitions. What about arm's length debt from banks, say?
For third-party debt, there's no specific ratio. The focus shifts to, is it commercially justified, or the term's arm's length? But, and this is key, regardless of the source, related or third-party, the EU's ATAD interest limitation rule applies.
Yes, the Anti-Tax Avoidance Directive rule. That caps interest deductions, right? How does it work?
Basically, it caps your exceeding borrowing costs, essentially net interest expense, at the higher of 30% of your tax EBITDA, or UR, $3 million a year. It's an overarching cap for all corporate taxpayers, SOPARFIs included.
So 85.15 is important for shareholder loans, but it's not the whole story. You also need commercial rationale, and you have to stay within the ATAD limits.
Exactly. You could meet 85.15, but if the interest rate isn't arm's length, or your total net interest hits the ATAD ceiling, you could still lose deductions. Conversely, even with only third-party debt, you need commercial justification, and you must respect the ATAD cap. It needs a full analysis, debt source, used terms, company profitability.
Right. A holistic view is essential for the tax side. Now, what about the actual tools? What's in the SOPARFI debt toolkit? How do they raise debt?
Well, thanks to the LSC's flexibility, they have a really wide range. You've got your standard bank loans and mortgages from local or international banks, shareholders, other lenders, secured under the Financial Collateral Law, or unsecured.
And bond.
Definitely. Short, medium, long term. Negotiable. Fixed or variable rates linked to Euribor, SOFR, even zero coupon. And as we said, the LSC is flexible. You can tweak the rules, use foreign law.
We also see more specialized stuff, like subordinated and convertible bonds.
Yes. Subordinated bonds or loans, they rank lower in priority, so they pay a higher yield for the extra risk. And convertible bonds debt that can convert into shares later. It mixes debt security with equity upside potential. You can even combine subordination and convertibility.
What about notes and warrants?
SOPARFIs issue various notes, subordinated notes, private loan notes, perhaps participate in MTN programs for regular issuance. Under the LSC, obligations usually means negotiable instruments like bonds or notes for multiple investors. Warrants, bond de souscription, give the right to buy shares later at a set price. Common for SAs and SCAs, often used for employee incentives or attached to other securities.
And Luxembourg is famous for those hybrid instruments, blurring debt and equity lines.
Absolutely. CPECs, PECs, profit participating loans, tracker certificates. These blend debt features, coupon redemption, with equity features, profit share, conversion, deep subordination.
I use them.
Often for specific tax or accounting outcomes or regulatory capital reasons. The terms are usually highly bespoke, detailed in contracts or offering docs. Their frequent use really shows Luxembourg's financial engineering strength, flexible company law, pragmatic tax approach historically, deep expertise, powerful tools, but you need ongoing expert review because the landscape keeps changing.
It definitely sounds like a comprehensive and adaptable toolkit. thanks mainly to the LSC. The choice of instrument clearly depends on the specific goal.
Precisely. Tax treatment, accounting impact, investor risk appetite, strategic goals, they all feed into the decision.
Let's zoom in on tax again. We touched on interest deductibility and the lack of withholding tax on interest. Can you expand on those key points for SOPARFIs?
Sure. Interest deductibility. Generally, yes, if commercially justified and arm's length, but subject to those limits we mentioned, the 85.15 ratio for related party debt funding participations, the overall ATAD interest cap, and critically, the non-deductibility of expenses linked to tax-exempt income, like from the participation exemption.
So you need to trace where the borrowed money is used.
Exactly. Careful tracing is needed. Now, withholding tax on interest payments by a SOPARFI, generally there isn't any, whether the recipient is resident or non-resident.
That's a big plus for attracting foreign lenders.
It is. There are some tiny exceptions linked to old EU rules or anti-abuse, but they rarely bite in standard corporate lending.
Okay, clear benefit there. What about dividend payments from a SOPARFI? Withholding tax applies then.
In principle, yes. There is a 15% domestic withholding tax. However, full exemptions are often available for qualifying parent companies.
What makes them qualifying?
Usually means being resident in the EU, EEA, or a treaty country, subject to a comparable corporate tax, and meeting minimum holding requirements, often 10% ownership or EUR 1.2 million acquisition cost, held for at least 12 months.
So interest generally flows out tax-free. Dividends are taxed unless an exemption applies, especially for corporate parents, and interest deductibility depends heavily on what the debt finances.
Exactly. If the debt finances something that generates taxable income for the SOPARFI, like lending activity, the interest is more likely deductible, still subject to ATAD. But if it finances a qualifying participation generating tax-exempt dividends or gains, the interest is typically not deductible to prevent double non-taxation.
Which leads to complex tax planning debt pushdowns hybrids.
Precisely. Tax efficiency is possible but nuanced. Needs careful expert navigation.
Now, bringing us right up to date, what were the key trends and developments in SOPARFI financing around May 9, 2025? What was the fresh intelligence?
Well, the trends back then largely mirrored the broader global markets. Geopolitics, inflation, higher rates had put a bit of a damper on transaction volumes in the prior year.
But Luxembourg held up okay.
Yeah, the market showed resilience. Financing, refinancing, restructurings kept happening. And there was some cautious optimism about new deals picking up later in 2025.
Any specific trends for SOPARFIs?
One big one was the continued rise of debt funds as alternative lenders. Many operate via Luxembourg platforms, offering borrowers more options, sometimes more flexible terms than traditional banks.
Regulatory watch points?
ATAD interest rules remain key. Tax authorities kept a close eye on transfer pricing and arm's-length intra-group financing. No major changes to the 85.1 practice right before May 25, but how it interacted with ATAD and anti-abuse rules was a constant focus.
What about sustainability? CSRD?
CSRD implementation was looming. The Luxembourg bill was expected early 2025. That was increasingly relevant for larger SOPARs. Enhanced sustainability disclosures could impact lender perception, access to sustainable finance.
Any other regulatory noise? MICA-DORA?
Those were developing too. Not direct SOPARFI financing rules, but part of the evolving compliance landscape. DORA, on digital resilience, is relevant for Treasury and financing functions' IT risk management. But fundamentally, no major CSSF circulars or laws changed the core debt financing rules for SOPARFIs just before May 9th. It was still about LSC flexibility, the Financial Collateral Law, and the nuanced tax environment.
So SOPARFIs were navigating market shifts like debt funds, plus evolving regulations on tax transparency, digital resilience, and increasingly, sustainability. Okay, comprehensive look at SOPARFIs. Let's shift now in part 3 to investment funds. Navigating the debt labyrinth there, we had that overview table, SIF, SICAR, RAIF, UCITS, part 2 UCIs, all distinct. How does that diversity affect their debt capacity?
Oh, it has huge implications. The fund vehicle choice dictates the legal framework, the target investors, and crucially, the rules around leverage and borrowing. Let's start with the regulated funds under the CSSF's gaze, SIFs, SICARs, and part 2 UCIs.
Right, these need CSSF approval for formation activities, including financing. Let's start with the SIF, the Specialized Investment Fund.
S are for well-informed investors. They offer a lot of flexibility in assets and strategies, but they do need to follow risk diversification rules. Interestingly, the SIF law itself doesn't impose specific statutory investment rules or explicit borrowing limits at the fund level.
No borrowing limits in the law itself. That seems quite open. So how is borrowing managed?
The key is most SIFs are AIFs, managed by authorized AIFMs, so they fall under the AIFMD framework.
Ah, so AIFMD brings the leverage controls.
Exactly. The AIFM calculates, manages, monitors leverage according to AIFMD. The SIF's own specific borrowing powers and limits will be in its constitutional documents and offering memo, all reviewed by the CSSF. There's a small restriction on FCP-type SIFs. The manager depository can't lend to unit holders, but that doesn't stop the SIF borrowing itself.
Okay, so SIF law is flexible on debt, but AIFMD provides the guardrails via the regulated AIFM. What about SICARs, investment companies and risk capital? Their focus is specific. Does that change things?
SICARs are also for well-informed investors, but focus purely on risk capital. Like SIFs, the SICAR law doesn't set specific borrowing limits or general investment restrictions beyond that risk capital focus.
So no statutory debt-to-equity ratios?
None in the SICAR law itself. They can issue shares, bonds, other debt. If it's an AIF, the AIFM manages leverage under AIFMD. Again, the specifics on borrowing are in the fund documents approved by CSSF.
And Part 2, UCIs. Regulated non-UCITs can reach retail investors in Luxembourg.
Part 2 UCIs are also AIFs. The Part 2 law doesn't seem to have the same explicit borrowing caps as UCITs, but their borrowing and leverage must align with their CSSF-approved investment policy and risk profile, and it's actively managed by the AIFM under AIFMD. Worth noting, the 2023 law expanded legal forms for Part 2 SICARs, but if using alternative forms for retail funds, they must have a fully authorized AIFM for investor protection.
So for these regulated AIFs, SIFs, SICARs, Part 2 UCIs, the pattern seems to be flexibility in the specific fund law, but counterbalanced by the comprehensive AIFMD framework applied by the AIFM. Investors really rely on the AIFM's competence and disclosure here.
That's a very accurate summary. CSSF oversight covers the fund docs and the AIFM's AIFMD compliance. It allows tailored leverage, but within a harmonized EU system.
Now let's talk RAIFs, the Reserved Alternative Investment Fund, famous for being unregulated at fund level but needing a regulated manager. How does that unique setup affect its debt use?
Right, the RAF, introduced in 2016, is distinctive. The RAF itself is not subject to direct CSSF prior approval or ongoing supervision.
No direct CSSF oversight of the fund.
Correct, but the crucial condition is it must be managed by an external, fully authorized AIFM from Luxembourg or another EU state. So it's indirectly regulated via the AIFM's supervision. It's not an option for internally managed or subthreshold AIFs.
And it combines SIF-SICAR features.
Yeah, it blends their operational and tax aspects. Reserved for well-informed investors, same definition, and EUR 100K minimum as SIFs-SICARs now after that 2023 law change. Minimum assets EUR 1.25 million within 24 months, also like SIFs-SICARs now.
So indirectly regulated via the AIFM, what does that mean for borrowing and leverage specifically?
Well, the RAF law itself doesn't impose any specific restrictions or limits on borrowing or leverage at the fund level. But because all REIs are AIFs managed by authorized AIFMs, they are fully subject to AIFD leverage rules.
So the AIFM handles it all under AIFMD, calculation, limits, disclosure.
Exactly. The AIFM defines policy, calculates leverage, gross commitment methods, sets and monitors limits, discloses to investors and the CSSF as per CSSF Circular 23844. The RAF's own documents will specify borrowing powers, maybe self-imposed limits too. And like SIF FCPs, the manager depository of an FCP RAF can't lend to unit holders, but the RAF can borrow from third parties.
So the AIF model gives faster launch times by skipping direct fund supervision, but still ensures protection via the AIFM regulation. Sounds like a popular compromise.
Hugely successful. RAIF numbers quickly overtook SIFs. It offers SIF-SICAR flexibility and tax benefits with much faster speed to market. Leverage is governed by AIFMD via the AIFM. Plus, you get the AIFMD marketing passport. Streamlined.
Okay, cover the AIFs. Now, UCITS, the gold standard for retail funds, highly protected investors. How does that strict approach affect their borrowing?
UCITS, governed by Part 1 of the 2010 law transposing the UCITS directive, are indeed the retail gold standard. And yes, because of that retail protection focus, their borrowing powers are very strictly limited.
Key point being they can't borrow for investment, right? Leverage is via derivatives.
Exactly. Prohibited from borrowing for investment purposes. Leverage comes mainly through derivatives.
And even for operational needs, liquidity management, the limits are tight.
Extremely tight. A UCITS can only borrow up to 10% of its NAV and only on a temporary basis.
Temporary meaning?
Short-term liquidity needs covering redemptions, managing settlement gaps. The move to T+1 settlement might increase the need for this, as the CSSF noted in FAQs. And crucially, UCITS are not allowed to grant loans or act as guarantors.
So any debt taken on by UCITS is minimal, purely short-term operational liquidity. Their main debt focus is investing in debt instruments within their policy limits.
Precisely. Lenders know these tight constraints. It's all about retail investor protection.
Now, we keep mentioning AIFMD. Let's dive deeper into its specific impact. Leverage, loan origination, reporting for AIFs. It's a really comprehensive framework.
It truly is. AIFMD sets the rules for AIFMs managing AIFs across the EU. It overlays the SIF, SICAR, AIF Part 2 UCI rules in Luxembourg, and leverage is a huge part of it.
How does AIFMD define leverage? Is it just borrowing cash?
No, it's much broader. It's any method increasing AIF exposure, borrowing cash, sure, but also embedded leverage and derivatives, short selling, etc. AIFMs have to calculate it using two methods: the gross method and the commitment method, detailed in the AIFMD Level 2 regulation.
Which method is used for regulatory limits?
Often the commitment method, especially for things like the new loan-originating AIF limits under AIFMD II. Though, note that temporary borrowing fully covered by capital commitments might be excluded from some calculations, like the AIFMD authorization threshold or certain loan-originating AIF leverage limit.
And the AIFM has big responsibilities here: policies, monitoring, limits, disclosure.
Absolutely. Establish robust policies and procedures to measure and monitor leverage. Set maximum leverage limits for each AIF. Disclose those limits, the type sources of leverage, the risks, all to investors, and regularly report detailed leverage info to national regulators, the CSSF, here under Circular 2003-844.
And AIFMD II, the recent update, brought specific changes for debt-related activities, especially loan origination.
Yes, Directive EU 224927 AIFMD II entered force April 15, 2024. Transposition deadline is April 16, 2026, reporting from April 2027. Big updates on loan origination and liquidity management tools, LMTs.
Let's tackle loan origination first. What are the key AIFMD changes there?
It defines a loan-originating AIF, basically. Its main strategy is originating loans, or originated loans make up at least 50% of its NAV. For these funds, AIFMD II sets specific leverage limits using the commitment method.
What are the limits?
175% of NAV for open-ended loan-originating AIFs, and 300% of NAV for closed-ended ones. Though national regulators might go stricter, it also brings in diversification rules, a 20% exposure limit per single borrower if that borrower is a financial undertaking, another AIF, or UCITS.
Is there a grace period for existing funds?
Yes, there's grandfathering until April 15, 2029 for these leverage and concentration limits, but only if the fund doesn't raise new capital after April 15, 2024.
And ESMA is developing detailed rules, the RTS, especially for open-ended loan-originating funds.
Correct. Crucial RTS are being worked on, focusing on liquidity redemptions, defining liquid assets for these open-ended funds. The consultation closed March 12, 2025. Final report and draft RTS are expected Q3 or Q4 2025, a slight delay.
Why are these RTS so anticipated?
Because they'll shape how open-ended private credit funds operate. The consultation, for example, discussed allowing expected loan cash flows to count as liquid assets under certain conditions. That's a big practical point.
Okay. AIFMD II also harmonized the rules around liquidity management tools, LMTs, for open-ended AIFs, bringing them closer to UCIs.
Yes. AIFMs of open-ended AIFs now must select and be ready to use at least 2 LMTs from a harmonized list. Temporary suspension doesn't count as one of the 2.
What's on the list? Gates, fees.
Redemption gates, notice periods, redemption fees, swing pricing, dual pricing, anti-dilution levies, and in-kind redemptions. And ESMA published the final guidelines and draft RTS on these LMTs on April 15, 2025.
What did those final ESMA reports say about LMTs?
The guidelines give managers a framework for selecting, calibrating, activating, deactivating LMTs. The final version is less prescriptive, putting more responsibility on the AIFM to develop a suitable internal LMT policy. The RTS specify the mechanics like how gate thresholds work, percent NAV, monetary value, percent liquid assets, an alternative gate method, and clarifying rules for in-kind redemptions for UCITS ETFs don't apply to authorized participants market makers.
And the timeline for these LMT rules?
The draft RTS went to the European Commission for endorsement. Takes a few months, usually. The guidelines themselves apply from April 16, 2026, alongside the AIFMD II transposition deadline.
So AIFMD II really signals a maturing AIF market. More detailed, harmonized rules for private credit, liquidity management. Sounds like a lot of work for AIFMs reviewing strategies, docs, risk management operations.
Absolutely. It's a significant overhaul needed. The goal is more stability, transparency, a level playing field. The grandfathering helps, but adaptation is key.
Okay, that covers the complex regulatory side for funds. Let's move to part 4 and look closer at the actual debt instruments available in Luxembourg's financial arsenal.
Right. Luxembourg entities have access to a really diverse toolkit. The choice, as always, depends on purpose, flexibility needs, investor appetite, tax accounting, regulations.
Starting with the basic standard bank loans.
Yeah, the foundation. SOPARFIs use them for acquisitions, refinancing, working capital. Funds use them for capital call facilities. NAV facilities can be secured using that Financial Collateral Law or unsecured. Bigger loans often use LMA or LSTA standard docs. One thing to watch is CRD 6, coming Jan 2027, might require non-EU lenders to EU borrowers to set up an EU branch, though exemptions are expected.
And bonds, we keep coming back to the flexibility Luxembourg offers there.
Yes, bonds offer flexibility and market access. Luxembourg Company Law, the LSC, is remarkably flexible for commercial companies, SOPARFIs, corporate funds if allowed, use Luxembourg law and tweak it, or foreign law and ignore LSC bond rules. Very attractive internationally.
Prospectus
If it's a public offer in the EU or for listing on an EU-regulated market like Luxi, then yes, the EU prospectus regulation usually applies. Needs a CSSF-approved prospectus, though exemptions exist, qualified investors, small number of non-qualifieds. Luxembourg also has lighter rules for some non-EU harmonized public offers.
and specific types, convertible and subordinated bonds, are common.
Definitely. Convertibles are hybrid debt now, potential shares later, can mean lower coupon for the issuer. Subordinated bonds rank lower in insolvency, so offer higher yield for the risk. The exact terms are crucial and defined in the docs.
And Luxembourg facilitates bond market access.
Very much so. Flexible law plus the Luxi as a top listing venue helps issuers diversify funding beyond banks, access larger capital pools, longer terms, fixed or floating rates. Plus, Luxembourg is big in the growing sustainable bond market, green, social, SLBs. It's a sophisticated ecosystem.
What about notes? How do they fit in? Are they just another name for bonds?
Yeah. Well, notes is a broad term. Can range from a simple bilateral loan note to publicly traded instruments. Under the LSC, obligations typically means negotiable instruments for multiple investors, like bonds or widely offered notes. A promissory note, billet outward, can have specific uses. Commercially, notes might be private loan notes, less transferable, or medium-term notes, MTNs, issued under a program, often listed, usually need prospectuses. Key differences are often negotiability, distribution breadth, and whether prospectus rules apply.
And subordinated notes work like subordinated bonds, lower ranking, higher yield.
Exactly. Same principle, just potentially different format or distribution, often used to layer capital between senior debt and equity.
Given they rank lower, how solid is subordination under Luxembourg law, especially in insolvency?
It's primarily based on contract law. Contractual subordination is generally recognized and upheld either in intercreditor agreements or direct agreements with the debtor. There's some theoretical debate versus the pari passu principle, but voluntary waiver via clear agreement is generally enforceable if it doesn't harm other unrelated creditors.
So in insolvency, the contract dictates the ranking.
Yes. Subordinated creditors get paid after senior, typically before equity. Ranking versus general unsecured creditors depends on the exact wording. Remember, the Financial Collateral Law governs security, while subordination governs the ranking of the unsecured claim or how proceeds from shared security are split.
Any CSSF hoops for subordinated notes?
Generally, no specific approval for SOPARFIs unless it's a public offer needing a prospectus. For regulated funds, debt terms, including subordination, would be in CSSF review documents or handled by the AIFM for RAIFs. Clarity in the contracts is paramount because it is contract-based. Define triggers and priorities clearly, and watch out for fraudulent preference rules in the run-up to insolvency.
Very clear. Okay, shifting gears slightly. Warrants, how do they feature?
Warrants, droit de souscription, bon de souscription, give the right, not obligation, to buy shares later at a set price and time. More equity-linked, but part of the broader financing picture.
Issued mainly by standard companies like SOPARFIs.
Yes, typically SAs and SCAs under the LSE framework. The board, if authorized, can issue them, often linked to authorized share capital. Need to consider shareholder preemptive rights might need waiver by shareholder vote with board justification. Can be standalone or attached to bonds, for instance, often used for management to employee incentives.
Less common for investment funds to issue warrants on their own shared units.
Much less common. Doesn't really fit UCI structures, may be possible for a corporate AIF, SICAV SA, if allowed, but raises issues with NAV, investor equality, regulation likely limited to closed-ended funds. So warrants are primarily a strategic tool for SOPARFIs. Prospectus rules apply if public offer or listed.
And finally, back to those hybrids PECs, CPECs. What's their unique selling point?
Their USP is blending debt and equity features. Debt-like. They often have a coupon, a redemption date. Equity-like, maybe profit participation, conversion rights, deep subordination, even voting rights sometimes.
And the main driver is usually tax or accounting treatment.
Often, yes. Getting interest deduction for tax but equity treatment for regulatory capital or consolidation. Terms are highly bespoke, set out in private agreements. Very common in intergroup financing or private equity structures. They really showcase Luxembourg's financial engineering skills, flexible law, pragmatic tax history, expert advisors. Powerful tools, but need constant expert review as rules evolve.
It's definitely a rich and complex toolkit. Maybe a quick comparative table summarizing the key features, issuers, uses, and legal points for each instrument could be a useful takeaway for listeners to visualize.
That's a great idea. Well, we haven't got one right here. Mapping out instrument features, typical issuers like SOPARFIs or specific funds, main uses, and key legal or regulatory flags like AIFMD or prospectus rules would be very helpful for comparison. Suitability always depends on the specifics, though.
Absolutely. Okay, let's move into part 5. The regulatory radar hot off the press, what was happening around May 9, 2025. The landscape is always shifting.
Constantly evolving, yes. Influenced by domestic, EU, and global factors.
So what was cooking at the CSSF, Luxembourg's regulator, back then?
They were busy refining and implementing the framework. Several key circulars were significant then. CSSF 24856, effective Jan 1, 2025, modernized rules on NAV errors and non-compliance for UCIs replacing an old one. Crucial for CSSF supervised funds.
Wow.
CSSF 23844 revised AIFM reporting, including leverage details. CSSF 22824 adopted EBA guidelines on loan origination and monitoring impacting banks and AIFMs originating loans. And CSSF Regulation 228, amended by 2410, had those borrower-based measures for residential mortgages LTV limits. Some temporary bits like cash collateral treatment were set to expire June 30, 2025, so the market was watching that.
Any really recent CSSF comms, say April, May 2025?
Mostly focused on implementing EU regulations. Big focus on MiCA the markets and crypto assets regulation. A whole series of CSSF circulars came out April 30th, 25, 885 to 890, implementing ESMA guidelines on crypto qualification, security transfers reporting.
Indirectly relevant if SOPAR's funds touch crypto, maybe as a collateral.
And DORA, digital resilient. Huge focus. CSSF extended the deadline for submitting the DORA information register to May 31st, 2025. Issued guidance on fixing register issues. Circulars 2588, 882 in April addressed DORA implementation, ICT risk, third-party providers. It impacts everyone, requiring ICT resilience and incident reporting.
Market data, settlement changes.
CSSF reported UCI assets hit EUR 5.75 trillion end of March 2025. They were monitoring T+1 settlement prep. FAQ suggested temporary borrowing within UCITS 10% limit might help manage it, and they announced using a secure cloud clearance for AI and supervision, piloting Q1 2025. But importantly, no major CSSF news specifically changing core debt financing rules for SOPARFIs funds right before May 9th, beyond these big implementation projects. Priorities were digital transformation, MiCA, DORA, AIFMD, UCITS, evolution, liquidity, resilience.
So lots happening, but mostly around digital crypto resilience and ongoing EU rule implementation, which shapes the context for debt financing. What about ESMA, the view from Paris?
ESMA is pivotal, shaping EU rules that influence CSSF and Luxembourg. The landmark event was April 15, 2025. Publication of the final reports on LMT guidelines and draft LMT RTS for AIFMD II and UCITS.
The liquidity management tools we discussed, what were the key points from those final ESMA reports?
The LMT guidelines provide the framework for managers selecting, calibrating, activating, deactivating tools. The final version was less prescriptive, emphasizing manager responsibility for a tailored internal LMT policy. The LMT RTS detail the mechanics, how gates work, thresholds based on NAV, value, liquid assets, notice periods, fees, swing pricing, etc., clarified rules on in-kind redemptions for UCI's ETFs too.
And the timeline for these LMT rules to bite.
Draft RTS went to the Commission for endorsement. Takes a few months. The guidelines themselves apply from April 16th, 2026, alongside AIFMD II transposition. Fund managers needed to start analyzing and preparing updating docs, policies, operations.
And the other big ESMA piece, the RTS for loan-originating AFs under AIFMD II status back then.
ESMA was still developing those crucial RTS, the consultation on open-ended ones, liquidity, redemptions, liquid assets, closed March 12, 2025. Final report draft RTS were expected Q3, Q4 2025, a bit delayed. The market was really waiting, especially on points like whether loan cash flows could count as liquid assets, critical for open-ended private credit funds.
Any other relevant ESMA activity around May 2025? ESG names? Consultations?
The ESMA guidelines on ESG fund names were live. CSSF implemented via Circular 24863. Deadline for existing funds to comply was May 21st, 2025. ESMA had also just closed consultations on simplified insider lists under Listing Act, and derivative transparency under MiFIR deadlines were around May 9th, relevant for listed debt issuers and derivative users. So yeah, ESMA's detailed work drives harmonization, crucial to track.
Definitely a busy European regulatory scene. Looking beyond those immediate updates, what broader legislative initiatives were on the horizon that could impact Luxembourg debt financing?
Several big ones. First, the major task of transposing AIFMD II and the amended UCITS directive into national law by April 16, 2026. That means significant updates to Luxembourg's AIFM law and UCI law covering loan origination, LMTs, delegation, depositaries.
What else? Retail investment strategy. CSRD.
The Retail Investment Strategy, RIS proposal is still being debated, aims to boost retail investor protection across MiFID, IDD, Solvency II SECs, AIFMD. But disagreements in Parliament Council, especially on inducements, made the timeline uncertain. Potential big impact on fund distribution, fees, advice. CSRD, the Sustainability Reporting Directive, was moving ahead. Luxembourg's Bill 8370 was expected Q1 2025. An EU tweak, omnibuside, delayed it 2 years for some firms, but the overall trend was clear. Affects many SOPARFIs and portfolio companies, feeding into SFDR disclosures and environment decisions.
And Luxembourg had already passed a law implementing MiCA and the European Green Bond Regulation.
Yes, law of February 6, 2025. Implemented MiCA, designating CSSF, setting sanctions, AML updates for crypto, and the UGB regulation. The UGB standard, largely applicable since December 21, 2024, provides that voluntary gold standard label for green bonds aligned with EU taxonomy, needing transparency and external review. CSSF supervises. The regulation also offers optional templates for other sustainable SLBs, expected to boost green finance. Overall direction, more harmonization, transparency, ESG digital, investor protection. Requires constant adaptation.
A lot to absorb. And sustainability itself is becoming mainstream in debt markets, not just niche.
Absolutely. Integral now. The European Green Bond Standard provides that voluntary benchmark, with strict rules on taxonomy alignment, transparency review. CSSF supervises. Luxi's LGX platform is a global leader here, saw a Sri Lankan green bond list April 1st, 2025.
Beyond the official UGB label, how is ESG being integrated more broadly? SLLs, SLBs.
We're seeing more sustainability-linked loans, SLLs, and bonds, SLBs. These link interest rates or terms to the borrower meeting specific ESG targets, SPTs. SOPARFIs and funds are increasingly exploring them. SFDR disclosures and the upcoming CSRD data are influencing lending decisions. ESMA's ESG fund name rules, deadline May 21st, impact fund strategies. And industry bodies like ALFI and LFF are actively promoting sustainable finance. It's evolving fast beyond specific labels. It's about integrating ESG into compliance, capital access, and risk management.
Finally, wrapping up the regulatory picture, what were the practical takeaways? What were law firms advising? What was the market chatter around May 2025?
Reflected intense regulatory digestion and prep. Key themes. AIFMD II, UCITS, LMTs were dominant final ESMA guidance, implications for liquidity risk, docs getting ready for April 2026. Watching the loan origination RTS development too, sustainable finance deadlines like the May 21 ESG fund name rule were pressing, applying UGB, considering CSRD impact. Digital finance implementation, CSSF circulars on MiCA DORA kept people busy, especially DORA's operational resilience impact. General market conditions, cautious optimism for more financing later in 2025, working through the new bankruptcy law's interaction with the Financial Collateral Law. Also, the recent Mobility Directive transposition enhancing reorg tools, and those ESMA consultations closing around May 9th.
So adapting to new EU rules, AIFMD II, LMTs, MiCA, DORA, UGB, CSRD, amidst a complex economy was the main game. But the core Luxembourg legal strengths LSC financial collateral law provide stability underneath.
Exactly, a stable foundation supporting adaptation to a complex, evolving superstructure.
Okay, brings us to part 6, the conclusion. It's definitely a sophisticated, dynamic landscape. What are the main overarching takeaways from our deep dive, looking back from May 2025?
Well, the Luxembourg debt financing scene then was this complex mix of flexible local laws, robust EU regulation, and a fast-moving market. For SOPARFIs, the key remained the LSC 1915's flexibility diverse debt options, ability to tweak bond rules or use foreign law. Tax was generally favorable, but with those crucial caveats on interest deductibility for exempt participation funding and the ATAD limits. The 85.15 practice for related party debt was a key guideline.
And for funds, it really depended on the type.
Absolutely. UCITS, very strict borrowing limits, 10% temp, leverage via derivatives, AIFs, SIFs, SICARs, RAIFs, Part 2. More flexibility in their own laws, but the AIFM is subject to comprehensive AIFMD rules on leverage, limits, monitoring, disclosure. And AIFMD II was a major development, new rules on loan origination, LMPs, with ESMA's LMT guidance finalized April 2025 and loan RTS expected later that year.
And the financial collateral law remained critical for secured debt.
Absolutely vital. Strong creditor protection, bankruptcy remoteness, and the broader trend towards EU harmonization, transparency, risk management, MICA, DORA, UGB, CSRD driving that. Navigating it all requires a holistic view, corporate fund law, tax, EU rules. Luxembourg offers a great platform, attractive and flexible, but the growing complexity means expert guidance is essential. Its ability to adapt keeps it a leading hub.
We've definitely covered a lot, navigating the intricacies of Luxembourg's debt financing landscape. We really hope this deep dive has given you valuable insights into the options, the regulations, and the trends shaping this absolutely vital ecosystem, at least as things stood on May 9, 2025.
Yeah, this analysis highlights just how dynamic Luxembourg's financial center is and why staying informed is so important.
For digging deeper into any specific topics or if you have follow-up questions, we definitely encourage you to explore the cited sources further and, of course, consult with expert advisors.
Hit that subscribe button. It was the Luxembourg Fundcast for you today.